Okay, everybody, welcome to my special State of the Market class. So this really is going to be very boring. I'm going to show a lot of numbers. I'm going to show a lot of charts, a lot of graphs, and I'm just going to present facts. Then I'm going to let you make the decision on how to interpret this data. You're more than welcome to ask me my interpretation of it. I'm going to do the best I can to stay away from any opinions or anything political on this. And I'm just going to caveat this right off the bat with the election that's coming is not going to stop the train I'm about to show you. Doesn't matter who wins. It's irrelevant. The train's already on the track. It's already picking up speed and it's barreling right at us. So it doesn't matter what happens that first Tuesday of November. This train is not stopping. All right. So let's just eliminate politics off of this right off the bat. So I'm going to be showing you a bunch of data and a bunch of numbers. We're going to start off with kind of squashing this big impression that Texas is the all-being market. And we're going to go into what everybody believes is Texas' hottest market, which they think is Austin. And I'm going to prove to you that Austin is not in any way, shape, or form a good market right now. As a matter of fact, as we plot Austin, Texas on the market cycle chart, you will see we're going to plot it right dab at the bottom of recession. It has not done good for a little while now. But there is a good sign to Austin, and I'll show that to you when we get into the numbers. And then we're going to look at Jacksonville, Florida. And my good friend George Estrada, who is on here, he has CoStar, and he was gracious enough to pull these reports for me for a client that had asked for these two markets. And so I just decided to throw them in here. He just pulled them yesterday. So I decided to throw them in here, and this would be a great way to show you how, even though in the real estate market, we can see where we are on the market cycle based on some data that we can get from a supply side resource like CoStar, how the economic data that is getting ready to hit us like a freight train is going to affect this. So you can't just rely on where we are in the real estate market cycle, because the business cycle leads what happens to the real estate cycle. So even though we see that Jacksonville is going to start possibly heading up the recovery side, and Austin may be hitting its bottom, even though we see that, is that actually what's going to happen based on the business cycle? So we're going to look at the business cycle because that is going to lead our real estate cycle in the near future. And I'm killing these plate sounds. There we go. No more ding dongs as people come in. So hopefully you guys will stay awake during this. I did this presentation on Wednesday in front of a group of commercial real estate brokers here in Mobile at the Association of Realtors. And I only put one asleep and one walked out. So it wasn't too bad out of 30. But the rest that were there said that this was much needed information, that they didn't know what was going on. So I kind of got a little test dry run with them before presenting this to you guys. So let's go through this. And again, if you have questions, please feel free to stop me as we do this. So this is Austin, Texas, as of yesterday via CoStar. And you can see we're in the multifamily sector. And if you guys have seen my market cycle reports that I did last year on YouTube, you'll know the criteria that we use to pull this, which is we remove student, we remove senior, we remove vacation, we remove military. So we're only looking at market and market/affordable. Okay. And honestly, when you look at the numbers, if you were to just select market and CoStar and then add market affordable, it only adds like 3 or 4 properties to almost 2,500 properties in the market. So it's not that big of a deal. I just like to throw it in there because it is market rent properties, basically conventional units. So it shows how many units are in the marketplace, how many are still under construction, and this huge absorption number. And so this is why I tell people you can't just look at data that's put in front of you to make a decision. We're missing a key component here. And we can see, and we can look at this and say, okay, there's no way, even though we've got almost 18,000 units that have absorbed in the last 12 months, which means, for those that don't know this, the calculation is end of period or end of year. In this case, it's 12 months, end of year, occupied units, only the occupied units. So households by definition, end of period or end of year occupied units minus beginning of period. All right, occupied units. So we don't know how many people moved out of the market. We don't know how many people moved into the market. All we know is the net result was that Austin's rental market grew by 17,841 units. So they rented 17,841 units more than went vacant. All right. We don't know how many were rented. We don't know how many went vacant. We just know the net result was a positive 17,841. So if that's the case, then why in the world do we see an increase of 3% in vacancy? Folks, this is a big vacancy number, 14.5%. Shame on Austin for letting this happen. That is a big number for a market like that. Okay. So when you see this amount of absorption and yet you still see this amount of vacancy, something's gone wrong in Austin. And you'll see, even though we still have 25,000 units under construction, that the amount of units that were delivered in Austin is a huge problem. And year over year, we've declined by 4.3% in rents, but you're going to see it's worse than this. All right. When we get to the data, we're not going to look at the capital market. So everything from this line right here to the left is the space market or the rental market. And everything from this line to the right, which is just these two, is the capital market or the sales market. We're not looking at the sales market. We're only looking at the rental market. Okay. And if we come down here and we look at the long-term occupancy average over the last 24 years, we can see Austin likes about 91.5. So it is well below its long-term occupancy average at 85.5% because of this vacancy rate, which is crazy. Okay, so let's go in and let's look at the numbers on this. Okay, let's try that again. Let's look at the, there it comes. All right, so we can see that there's the number of total properties. So inventory buildings just means properties in the market. And we saw the total number of units. Now, this is quarter to date. We're going to ignore quarter to date at the top. Let's focus on the one right below that. And let me increase this a little bit so you can see it a little better. Okay. So, and we're going to look at effective rent, not asking rent, because we don't care what owners ask. That means nothing. What are they actually getting for the apartment? What's the lease rent? So that's effective rent. So that's asking rent minus concessions. That's what effective rent is. So if we look at effective rent per unit, we can see that they peaked at $1,753, which was the second quarter of 2022. Who remembers what happened in the second quarter of 2022? What started? Matter of fact, it was March, but it was really felt going into the second quarter of 2022. But it started in March. What happened?
Interest rates?
Interest rates went up for the first time in March of 2022. Okay. So as interest rates started to go up, rents peaked. Now they fluctuated a little bit, but as they got into 2023 and deep into 2023, the residents finally said, that's it. We've had enough. We don't like these rents. We're not paying this anymore. So rents started to decline. pretty big compared to the peak. So if it peaked at 1753 and it's currently at 1609, remember I said I'm going to ignore fourth quarter quarter to date just because there's not enough data yet to have the quarterly data. So that's why I ignore it. So let's just call it 1609 second quarter 2024. You've got 1609 per unit. That is down what, $144 a month. Yet in 2021, 2022, when they bought these properties, they were expecting a $200, $300, $400 rent bump. So you can see that a lot of properties in Austin could potentially be in a lot of trouble because of this, because NOIs have been dropping. All right. And then if we scroll over and we look at the occupancy, so we could see vacancy has been increasing, and it has been increasing since where did it peak? It peaked at 5.8 in the market 2021 Q3. So since then, vacancy has been increasing. Okay. Which is not a good sign at all. And it has not slowed down. I mean, it has not slowed down at all. But we will see when we get over to absorption and deliveries, we're going to see that it has started to wane if we do look at that fourth quarter. Now, again, we can't really, or look at this top line, the third quarter. We really can't look at that data, but it can kind of give us maybe some hope for Austin. So let's keep scrolling over and we can see the amount of deliveries in the last 12 months. So if you add all this up, so let's say what's this, 5,000, 14,000, 21, almost 22,000, 29,000 total units absorbed. And if we remember, we were what? Let this pop in and show. 17,000 absorbed. So 29,000 delivered, only 18, almost 18,000 absorbed. And that's why your vacancy is increasing at the peak that it is increasing at. So how did we do with absorption during that same time frame? Well, if we come down, if we look at 4,979 delivered in the fourth quarter of 23, only 1,525 absorbed. That is terrible, which is why you had 0.75% increase in vacancy, decrease in occupancy. Okay, that is terrible. Then you had 9,100 deliver and only 4,600 absorb. Then you had 7,600 deliver and only 56 absorb. 6,600 deliver, only 5,600 have absorbed in the this quarter. So it is continuing, although again, we can't really look at this top line, but it has slightly slowed, if you will. So maybe there's an indication it could be slowing. That would be a good sign for Austin, but there's not enough data yet to say. So if we look at this, we are clearly negative rent growth, We are increasing in vacancy, clearly. We are well below that long-term occupancy line. So if we look at our market cycle chart, it is clear that you would be good putting Austin either on this point or this point. I'm probably going to throw it all the way down here in this bottom rung because 15% is a big number for Austin. How much further can it go? You're either way, here or here, you're definitely deep in because remember 91% was where it likes to be long-term occupancy, and it's at 84.5%. So either one of these two is fine. You've got negative rent growth year over year. That's what drops us into recession. And you have increasing vacancy, which also drops us into recession. So Austin is clearly in the recession part of the cycle. Would anybody disagree with this assumption? And it's not an assumption, it's a fact, but does anybody disagree with it? So somebody posted on my Facebook page or Facebook, one of my Facebook groups, an IRR report. IRR will put out its own little market cycle report. And IRR's report is a current report. It's mid-year market cycle report. Do you know where they put Austin on their mid-year market cycle report? I got to have engagement, guys. At least give me a guess. Something.
Very bottom.
Okay. George says at the bottom. I assume you mean recession, George.
That is correct.
Okay. Anybody else want to guess? They put it in expansion.
Holy
And you
moly.
guys just looked at the data. What in the world puts Austin in expansion? In whose world would put Austin in expansion? And that's insane. So you got to be careful at the reports you look at. All right. A lot of people put a lot of emphasis on these IRR reports. I'm okay putting a lot of emphasis on cap rate. If you want to use it for cap rate, remember, it's only produced twice a year. It's published in August or July, August timeframe for the mid-year, and it's published around January for the beginning of year. That's it, twice a year. And so you've got to be careful when you look at these reports, because in no way, shape, or form is Austin in the expansion cycle. All right. And I had somebody ask that question. So that's what spurred me to do this. Okay. Now let's look at Jacksonville.
Hey, but David,
Yes, go ahead.
so in with their interpretation, are they more focused on construction? Because based on the data that you showed that there are a large number of units under construction, right, in Austin.
Well, one thing that IRR adds, if you look at how they determine their positioning on their cycle chart, is they add economic data like employment to their decision-making process. But the real estate market cycle is just that. It is real estate. It has nothing to do with employment. Nothing at all to do with employment. Now, we know that employment is a driver of demand, but when we look at the data, we got to look at the supply side data. And that supply side data is what tells us where we plotted in the market cycle. We don't look at the employment data. We look at the employment data for growth. We look at the employment data for demand, but we're not looking at that. We're looking at what is the demand supply based on the residents themselves, based on the units themselves. So we're only looking at the supply side information. Is the unit filling or is it not? That's it. Okay. So if we pull up, and I'll pull up Dr. Muller's in a minute. I've got Dr. Muller's market cycle report also that we can gauge it against mine and against IRRs. But let's look at Jacksonville. So Jacksonville has 1,403 properties, 126,000 units. They still have 5,979 under construction, and they have absorbed 6,200 in the last 12 months. But like Austin, they have increased their vacancy, albeit not as fast of a pace. And they're a little bit less than Austin total vacancy. If we look down here, we can see that Jacksonville likes to be about 91%, similar to Austin. Austin was 91.5. Jacksonville's really 90.75. So they're pretty close to the same long-term occupancy average. But again, we're well below it at 86.7%. Okay. So looking at that, we can say more than likely, because there are units being delivered and we have absorption and we have a vacancy rate, that we're going to be looking at the long-term occupancy average on the right-hand side of the chart. And then if we add rent growth in there as well, year over year negative. So we got negative rent growth. We got vacancy increasing, and we have deliveries going into the unit. It looks like on face value that we're plotting the Jacksonville market in the recession phase. Or are we? Let's take a look and see where Jacksonville may actually be plotted. So let's go look at the data. And that's why the data is so important to look at and not just some infographic. So let's go grab Jacksonville's data. Let's blow this one up. so that we can see it. And we can see that our effective rent, it peaked. Let's see if we can see when it peaked. It looks like it peaked around first quarter of 2023 at 1547, and it has been slowly going down ever since. But if we look here, okay, it went down, 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 and then it stabilized going into fourth quarter of 20 or first quarter of 2024 and increased a little bit, albeit it's showing a lower number again now. But remember, we're not going to look at this top line, but we have an increase in rent per unit here. That's interesting. So steady decline until we get to second quarter, and then we have an increase. Well, let's see what absorption and delivery show us and what occupancy shows us to see if this increase was justified. Because remember, if vacancy is increasing, rents should be decreasing. That is a demand supply principle. If vacancy is decreasing, then rents should increase. Okay. Now, one would argue that your rent shouldn't increase at this level of vacancy at 13.5%. But looking at the demand supply principle, let's see if the demand for units have come back based on deliveries. So let's go look at our deliveries and our absorption. So we had that to first quarter to second quarter. So we were at 2849 in the first quarter. And if we look at absorbed units, it was only 1154. And we declined in rents that quarter. Then we delivered 1,940 units in the second quarter. But look at this. Demand came back. The renter said, okay, now we're at a rent we kind of like. And I don't know if something economically happened in Jacksonville that brought future population or brought population to the market. And if that possibly could have been this, or if the renters are just coming back to the market because the market now is getting to a level of rent that they could afford. We don't know the answer to that because I didn't do an economic based analysis. So I don't know if there was a population that came to Jacksonville for a reason for employment or other reasons. All we know is demand is back. Demand is exceeding supply in the second quarter, which justifies that rental increase. So seeing that, and we can see it again, if we look one more time, even though I said we're not going to look at this top line, we had 1,225 deliver quarter to date and 1,552 have absorbed quarter to date. So the demand is still there. All right. If you remember in Austin, the demand was not there and they still had 20 something thousand units left to deliver. But even though we have about 6,000 units left to deliver in this market, it's keeping up. As a matter of fact, it's exceeding. So we're seeing rents start to potentially increase. We're seeing occupancy start to increase. And we're seeing demand come back, absorptions exceeding deliveries. So where would you guys plot this on the market cycle chart?
Expansion.
Ooh, you're a little aggressive, George.
Oversupply?
Now you're just guessing, buddy.
Yeah.
You had your guess. Just, we'll leave you in a. All right.
Well, because the rents are continuously, the numbers you're explaining to us, you're showing that it's going to be continue growing. It shows that it's going to continue growing. It's we're not in a recession because I would think if we're in a recession, the numbers will start going down or going the opposite direction.
Okay. You cannot skip a phase. Anybody else want to say where they'd plot it? Kevin, you unmuted.
I have it in recovery. It's still below long-term vacancy average, but you're starting to see absorption. So I put it in early recovery or something like that.
Okay.
Yeah,
Anybody
this
else?
is John. I would also
John.
say recovery also.
Okay. Anybody else?
Yeah, I would say recovery as well, based on the indicators.
Okay. And I don't have my chat up. I guess I should have my chat up. Ivan says oversupply. Kevin says recovery. And Charles says early in recovery. Yeah, I'd agree. I'd plot it right here, right at the bottom in recovery. Because we had that tick down and again, we don't have enough data yet for the quarter, but looking at it, we can see that quarter to date, we did have a decrease in rents, even though we still have more absorbed units than we have deliveries. So it's showing the demand there. So I think comfortably, I'd plot it right here at the bottom. Okay. So we have a market that's getting ready to recover. Interesting. There's actually a couple according to Dr. Muller. So let's look at Dr. Muller's and see how we compare to his. Now, keep in mind, he's first quarter. His second quarter hasn't come out yet. This is his first quarter report. So if we look at Dr. Muller and we look down here at Austin, he's got Austin right where we plotted it. Okay, 0.16. And if we look at Jacksonville, he's got Jacksonville right where we plotted it in recovery. And last quarter, he had Jacksonville sitting here at 0.16. That's what that 0.1 mean or +1 means. So if you see +1 on this cycle chart, that means it went forward 1 plot point. We can see Memphis went 2. So he had Memphis at 16 last quarter, and he moved it 2 spots up. Okay, now I haven't seen Memphis's data, so I don't know if what he sees supports moving it there. But again, what we just saw with Austin and Jacksonville, we're right on the money with what Dr. Muller says. I don't remember what that IRR report said, or if it even had Jacksonville on the IRR report. But it had Austin in expansion, which is just insane. I don't know. He pulled Norfolk back. So he had Norfolk at 0.13. He pulled it all the way back to expansion. But I think that has to do with a lot of the job announcements that have happened in Norfolk. And so that has increased the demand there. And so that may be why he has pulled it back, but I haven't seen the data to know why he pulled it back. It'll be interesting to see where he puts it going into the second quarter 2024, and if he leaves it there or if he starts to move it forward again. So you can see by looking at the market cycle chart that Dr. Muller puts out, who is one of the foremost experts on market cycles. Everybody kind of does their data off of his, except maybe IRR, because who knows what the hell they're thinking. But now let's go look at a bunch of charts and graphs that show us what's happening in our national economy and see if we're going to be really excited about what's going on in Jacksonville, because it's starting to hit recovery. And we know if you buy at the bottom, that is the best place to buy, because you buy low, sell high, right? Or potentially even Austin if it continues. Now, I could tell you right now, if Warren Buffett was in the market for real estate, he'd be buying in Austin today. Absolutely 100%. Because of where it's plotted. Warren Buffett buys because he likes a little risk. He buys before it gets to the bottom. And that's what I tell people. If you've got the chutzpah, or however that word is, to buy at 16, then you will do the best going into the next cycle. But you got to pay attention to what's happening economically. All right. There are some factors that are going to affect how long it's going to take this recovery to occur. Notice how flat Dr. Muller has this as it goes up into recovery versus how steep it stays in recession. Okay. The shortest period of time is in recession. The longest period of time is in expansion, but it may take it a while to get there. And this is where the election will become a factor, is how long do we stay either in recession or on that recovery side. So based on who comes into office will determine how quickly we can get back up into this expansion cycle. So let's look at our national numbers. Here we go. All right. So we're going to start with treasuries. Everybody in real estate is relying on this stupid Fed fund rate. I don't know how to tell you guys that Fed fund rate doesn't mean shit. It doesn't. It doesn't mean a damn thing, especially with what's coming. Okay. It is reactionary to markets. The 10-year treasury matters to real estate because how do lenders lend? They lend off the 10-year. They get their spread off that 10-year. Now they purchase from the Fed. Okay. They get their bond from the Fed at whatever the Fed fund rate is. So right now it's what, 5.25 or 5.5, something like that. So that's what it costs them to get that bond. And then they turn around and they sell it to you based on what the 10-year is doing and based on risk and a whole bunch of other things. So as the 10-year fluctuates, you can see Freddie Mac is a perfect example. Freddie Mac has been fluctuating even though the Fed has stayed at 5.25, 5.5 for what, over a year now? Yeah, we're in August. We're now in the 13th month at this because the July meeting was the last time they raised rates last year. So we're at 13 months now at 5.25, and I've got the chart. We can see what it is. Matter of fact, let's just see what it is. At 5.33. So basically 5.25. So in between what I was saying. But what I want to show you here is something that's a little troubling. So this is showing, this is the 10-year, 2-year spread, the yield curve. Anybody here not heard of the yield curve? Okay, everybody's heard of the yield curve. Does anybody know what its significance is? Why do we care about the yield curve? You've heard about it, so there must be some importance to it. Talk to me, folks. Put it in the chat or unmute. What's the significance of the yield curve? Why do we care?
They say it's a predictor of recessions, even though it's not the most accurate.
Well, we'll see about that, John.
Yeah, I don't believe it, but that's what they say.
Okay. Well, I'm going to show it to you. Let the data speak for itself. That's why I say that data-driven approach, guys. If you don't know my tagline, it's doing deals with a data-driven approach. Okay. Everything is driven on data. I could care less what somebody thinks. It's data-driven. So we'll look at the data. So the yield curve is when the 10-year is more valuable than the 2-year, which is pretty much in normal economic conditions. It's above this zero line. So this zero line is the 2-year. The squiggly line is the 10-year, and the 10-year's relationship to the 2-year. So in normal conditions, the 10-year is above the 2-year in value, meaning investors in the bond markets will put more money long-term than they will short-term. When there's volatility, when there's uncertainty, then the investors will take their money out of the 10-year and they'll put it in the 2-year because they want to be more liquid. And so to be more liquid, they put their money in the 2-year or even the 3-month. And I'm getting ready to show you the 3-month because the 2-year only goes back to 1976. And I want to show you all the way back to the Great Recession or the Great Depression on how the correlation between the yield curve works. So we're looking at the 10-year, 2-year here. I'm getting ready to show you the 10-year, 3-month. But if we look at these gray sessions, these gray areas, these are recessions. So here's the 1980 recession and then the 81 to 83 when inflation kind of drove this whole bust. And we'll get a look at this in a little while. But you can see that the yield curve was inverted for quite some time. And then it went back above and then it dropped below again. And I'm going to show you the relationships on the amount of time here. Then it dropped again prior to the 1990 recession. And then after it recovered again, here it recovered in the recessions. Here it recovered before the recession. Before the dot-com bubble, we had another long period of time and then it recovered and went into recession. Here was the great financial crisis, recovered, went into recession, and then COVID, and we don't COVID was an anomaly. I'm not going to even look at the COVID recession. You're going to see what it did to jobs and the peak that it created. But again, it's just because the world shut down. And that's going to create a black swan event, and why it's the shortest recessionary period in history, because it was just a black swan event. So we really don't care about that. But we don't have enough here to tell us the yield curves relationship. We can see that the yield curve inverted before every single one of these recessions. Yet it also, except for because inflation was driving these two, and we were coming out of the Vietnam War, was another thing that drove these supply chain issues, because factories during wartime get switched for other reasons, and that affected everything that happened here as well as after World War I and World War II. But we can see that the yield curve inverted prior to every single one of these recessions. But let's look at what it did with the 3-month. And so I wanted to go all the way back to 1920. So prior to the Great Depression, and this was the Great Depression here, 1929 to 1932 was the Great Depression, we can see that the yield curve inverted for 700 days. Now, this was the 3-month, the 10-year 3-month. Okay. After that, I'll be showing you the 10-year 2-year. Here is the 10-year 3-month, because the 2-year, they only started in 1976 recording that. This was the first recession recorded in history. You could see the yield curve was inverted in that recession. Here it inverted prior to the Great Depression, was inverted for 700 days. And when it reverted, they went into a major crash. Now, this affected a lot. It affected equities. It affected real estate. It affected financial institutions. That was the Great Depression. Then we can see it did not invert here. So this is one time where it did not invert for after World War II. Then the next recession was the late 50s, early 60s. It did invert prior to that one, but it reverted. It inverted, then reverted, then went into recession. Here it inverted, did not go into recession. Okay. Here it inverted, did go into recession in 1970. And then 1974 was a big one where it inverted. And I want to say this one was 300 something days it was inverted. Then, of course, we had the just mess with Fed fund rates, with the yield curve inverting, with inflation. Fed thought they captured it, didn't capture it. It went back up again. This was the late 70s, early 80s when mortgage rates on homes were 18+%. That was 446 days. Here before, now it inverted slightly prior to the 1990 recession, inverted for 254 days before the dot-com bubble, inverted 235 days before the great financial crisis, and now it almost reverted. You guys see where it is Friday? The 10-year, 2-year relationship? We're within 1 basis point of reverting. It's the closest we've been for 788 days. Okay, I did this presentation on Wednesday. It was 785 days on Wednesday. Today is Saturday. 788 days we've been inverted. Longest in history. And they say, I don't know if this is true or not, but you can kind of look at it, that based on the amount of time it's been inverted, is a correlation to how long it takes to get out the backside and how bad it's going to be. Okay, the longest in history before this was the Great Depression. We all saw what happened there. 3-year period, almost 3-year period, and that was 700 days. We're at 788 days today. And again, we almost reverted. We came within 1 basis point of reverting on Friday, yesterday, but we're basically flat at the moment. All right, you can call that flat, 1 basis point. All right. So, John, now you've seen the data. Now you can make your own decision on the correlation between the yield curve. So this is the bond market. The correlation between what the yield curve does and does that affect going into the next recession or not? Is that a bellwether? Is that a leading indicator? So for me, clearly a leading indicator. I mean, 95% of every single recession since the Great Depression, it has been an indicator. That's a pretty clear indication, especially for as long as we've been inverted. I think you guys are going to find we've actually been in a recession, not a technical recession. Technical recession is defined as 2 quarters of negative GDP. We don't even have 1 quarter of negative GDP yet. That's just a technical recession. But a true recession is what's happening with employment, what's happening with wages, what's happening with manufacturing, what's happening with financial institutions, what's happening with the bond market. All of those indicators are showing we've been in recession since about March or April. And most economists believe that right now. All right, so any questions on the yield curve before we move to our next chart? Okay, I didn't say this was going to be pretty. The last piece of data I have to give you is the most troubling. So you'll see when we get there. All right, so here is the Fed fund rate, and this is where we are today. Now I just want to show you its correlation, the Fed fund rate, its correlation and its relationship to every recession dating back to 1955, because that is when they started tracking the Fed fund rate. So if we look, the Fed fund rate went up, 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 and then they ticked up this little bit right here, and uh-oh, that wasn't good, and boom, triggered them into a recession. So this tick up triggered them into a recession, that 1957 recession. Then we get into the early 1960s. They were even, said, oh, crap, we got to start lowering. And lo and behold, they went into recession. So the lowering of the Fed fund rate does not stop the train. Okay, so they lower the Fed fund rate and boom, recession. Okay, up, 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 up. Then we've got some down movement and then up, 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 and away. And then, oh, crap. And you'll see the correlation between employment here in a minute, and blam, they lower, lower, lower. Oh, economy's looking good again. Let's go ahead and raise some. Oop, we see some cracks. Let's lower again. Oh no, we were wrong. We can start raising. And then we go into the 1974 recession, which had the 3rd longest period of yield curve inversion prior to this recession. So you can see that they are reactionary in every single case when they lower after a long period of holding, okay, or raising. Happened again, and guess what? It's going to happen again, okay? So they are going to lower in September. For those that don't believe they're going to lower, I don't care. Well, I've seen what jobs have been doing. You're about to see what jobs have been doing. The jobs number comes out, the new jobs number, the monthly number, the one that tanked the stock market early this month. That number comes out next Friday, so in 6 days. I don't care what it does. The Fed's lowering rates at the September meeting. And then the following week on the 11th, so that's the 6th, the jobs number comes out. On the 11th, the new CPI comes out. And either the 10th or 12th, I don't know which one, PPI will come out, which is the producer price index. All right, so wholesale goods. So consumer comes out, consumer inflation comes out Wednesday, and either Tuesday or Thursday, the wholesale inflation will come out, which is the producer price index. Okay, regardless of what happens there, all that's going to do with what happens to those is how far they lower. They will lower at least a 1/4 point. Most people believe it's going to be a 1/2 point. And if the numbers are as bad as it's looking with the weekly claims that we've been seeing, including the continuous claims that I'm going to show you in a little bit, they may go 3/4 point. If they do that, expect the stock market to fall right out the bottom. That will trigger the visual recession. We're already in recession, make no mistake. That will trigger the visual recession if they go 3/4 point. It may even trigger it at a 1/2 point. At a 1/4 point, I think the stock market will be fine, but I think a 1/2 point signals something's wrong. And when something happens, boom, it goes. See, we just lost one. I'm telling you, this data is dry. I try to make it as exciting as possible, but it's damn near impossible. So let's look at the next chart. So now we've got consumer price index, the CPI, with the Fed fund rate. So we can see in red is CPI. So CPI peaked right about May of last year. And that is about the time, March is when they started raising the rates. And you can see as they've been raising it, it brought CPI all the way down. And then they've been sitting here for a year, and CPI's just been waffling year over year since. Now, keep in mind, they changed in January. When is this? This is July 23. In January 2024, they changed how we look at CPI. All right. So this is the last part of this is not apples to apples, but it's close enough. And here is how the Fed fund has reacted to it. Now, if we go back and look, you can see that it follows the Fed fund and CPI. Pretty good correlation in history, except for maybe just a couple of times, but a pretty good correlation. All right, in our history. So that data is there, and you can see that data. Okay. So you understand why the Fed does what they do with inflation, because there is a correlation between those ups and downs. It's been a little different because we've been at zero. We've never been at zero before. This is the first time in our lifetimes that we've seen zero interest rates. So CPI didn't know what the heck to do with zero interest rates. And Trump saw that and said, we got to start raising. So Trump started raising, and even with his raising, CPI stayed fine. And then, of course, COVID hit. We went back to zero. And then that's when all hell broke loose. And of course, then they trucked it back up since. Now, look, politically, did the Biden administration cause this? I don't think so. I think that the culmination of this long period of zero interest rate and then the supply chain doing what it did, freezing up, that's really what caused this, not the fact we went back to zero again. So politically speaking, you can't say politics caused this coming out of the COVID. It was more a factor of just zero interest rates for such a long period of time, and supply chain disruption is really what caused that. Okay. Our next one is how unemployment reacts to the Fed fund rate. And it's not that unemployment reacts to the fund rate, it's how the Fed fund rate reacts to employment. So if we come all the way back to 1955, unemployment rate is in blue. Okay. So we can see that the unemployment rate starts to go up before the Fed fund rate goes down. Okay. We could see that correlation. Here, did it again. The unemployment led the Fed fund rate going down. Next recession, here, we kind of trucked along, and they actually went up. The Fed fund rate went, or the unemployment rate went up, and it looks like it led it by maybe a month. Yeah, it looks like it led it by 1 or 2 months, and then the Fed reacted down. Okay, next one, Fed fund rate up, and away, and then unemployment starts to take off, and it must have been inflation that triggered them to go up again. Why you would be raising rates with unemployment increasing, I don't know, but they changed their mind and said, "Oop, nope." And again, reactionary. So you can see before, and I'm going to go through all of them, but you could see it every single time that the unemployment rate starting to go up leads the Fed to that down rate every single time. Okay. So now we're seeing that Fed fund rate go up, or I'm sorry, the unemployment rate go up. And what's happened? Feds now say, all right, let's go ahead and take it down. So once again, reactionary. So if it's like history, expect a big climb up and a big climb down. Will we go back to zero? No. We're hearing somewhere around 3.5, 3.5 is where they're expecting the Fed fund rate to go to by the end of 25, going into 26. We'll see. I think it might get a little more aggressive than that. I think it'll go down into the 2s. I don't think we'll see it go back to zero. Any questions on this chart?
David, quick question. Since you're saying that it's gonna go down, well, they're saying that it's gonna go down to 25. It's gonna be a great opportunity to buy, right? The rates are gonna be better. If you have any dry powder, of course.
And you're going to have dry powder. Why do you think Warren Buffett is putting all his money in cash? He sees what's coming. He sees these charts. He knows these charts. He studies this stuff. He knows what's happening in the financial world. He knows what's happening in the bond market. He knows what's happening in the equity market. He knows what's happening in the employment market. He's watching all of this. He's taking all of that into consideration, and he's holding on to cash. Because when you have a market and you're studying that market cycle chart, when you've got a market that is at the bottom of recession or maybe even at the beginning of recovery, and it looks like that we're completing our unemployment cycle, and you have lower interest rates, that is the recipe that will take our recovery and launch it up. So you're right, George. But you've got to pay attention to when we peak on the unemployment. And there'll be indicators just like there is in the real estate sector. All right, this next one is unemployment to average hourly earnings. So you can see that they almost were directly correlated. Average hourly earnings peaked in April of 2022 and started to go down. And as hourly earnings went down, unemployment ticked up. So we can see that correlation. And you can see that correlation across its history. Okay. Then we go into continued claims with the unemployment rate. So here's continued claims at the bottom. What that means is people that are currently on unemployment, they are receiving unemployment from their employer's unemployment insurance. And that's why it says insured unemployment. That's continued claims. When we look at weekly jobless claims that come out every Thursday, those are new people going on unemployment, okay? And I want to show you that correlation here in just a second, the difference between new and continued claims and how that's starting to spread, which is not a good sign. You don't want that spreading. You want it declining because that shows that the labor market is strengthening, but that's not what's happening. And we can see that continued jobless claims are continuing to go up. We're at 1,869,000 currently on unemployment, and unemployment has ticked up to 4.3. We get the new number next week. Questions on this one? All right, here is new claims versus continued claims. So initial claims are in red. Okay, that's the red chart. These are initial claims, and new continued claims are in blue. So if we look at August numbered, last week's continued claims came in at 233,000, which was a 1,000 decrease from the week prior. But here's the problem. Even though we had a decrease in claims, look at the total. We're at 1,868,000. If I go back 1 week, okay, we actually increased to from 1,855,000 to 1,868,000. So your net result is that you're having more claims. So not as many people are coming off that are coming on. And that's the bad part of this. And that's why when you kind of look at this, you can see that delta, we see how small the delta is here. We can see that delta is spreading as we continue forward. Okay. So these are the kind of numbers you can look at and pay attention to all week long, every week. Every Thursday at 10 a.m. Eastern time, the weekly jobless claims come out. Every Friday, every first Friday of the month, the new unemployment rate and employment numbers come out. Did you guys see last week when the revision came out for the annual employment increase for 2023? So in March, they reported there were 2.9 million people that got jobs. So we increased by 2.9 million people in 2023. That was the number that came out. Well, that is a number that is a predictor because it takes the Bureau of Labor Statistics time to actually go through all of the data. So what they do is they look at the employers that actually submit unemployment insurance for employees. And that's how they know how many employees hit the books. Okay. So you can already see with this U3 number, this does not take into consideration independent contractors or self-employed people. It only takes into consideration people that are employed. All right. That's why the U6 number is much more accurate, because it actually takes into consideration self-employed people. But U3 is what we have. U3 is what the government shows everybody. So that's what I'm using. I don't want to skew the data for what could be considered political reasons. All right. Just know U6 is much worse than U3. All right. So that's our delta. Oh, the update. Do you guys know what the revision was? So March, it came in at 2.9 million. They revised it last week. Do you know what they revised it down to? And make no mistake, it's always revised down. Oh, you guys got to pay attention to the labor market. It's more than just real estate, folks. They raised it down. They revised it down 818,000. Largest revision since 1990. I'm sorry, since 2009. Largest revision since 2009. 818,000. So it did not increase by 2.9 million. It only increased by 2.1 million. Okay. Now we'll see what that does to the unemployment rate next week. I'm not sure what that's going to do. I don't know. That's going to be new to me. Looking at weekless jobless claims and seeing this delta increase and seeing how negative the service industry is right now, we might see some bad numbers come out next week, but I don't know. Not going to say one way or the other what it looks like, because I honestly don't know until it gets here. All right. University of Michigan consumer sentiment. This is how consumers feel. Are they spending money or not? Okay. And we can see in blue is consumer sentiment and average hourly earnings in red. So we can see that consumer sentiment pretty much was at its peak. So or at its worst, which is interesting when wages were the highest. I'm sorry. The lower the number, the better here. The higher the number, the worse it is. And so you've got consumer sentiment up here. And now as wages go down, consumer sentiment's the higher the number. So it's an quarterly index number. So the higher the number, the higher the sentiment, the more they're spending money. The lower the number, the least they're spending money. So as the hourly wages go down, we can see that they're now getting to a point where people are stopping spending money. Here, if you remember the stimulus checks that were entering the market after COVID? The IRS sent what? $2,500 or $3,000 or $3,500 to everybody in the frickin' that paid their taxes. You got stimulus money. That stimulus money spurred spending, even though the sentiment went down. Now it peaked going up, and then it went down big time. Now, as earnings were going up, sentiment was going down. I don't know what caused that. That's a reverse than what you normally see. Normally you see it kind of follows. So this was an anomaly here, but now we're starting to see that correlation between the downtrend. So we'll see how this keeps going down. Here's average hourly earnings to the consumer price index. So this is inflation. So again, as our wages fall, we can see that inflation falls because people aren't spending as much money. Demand lowers. And when demand gets weaker, CPI gets smaller. Okay, it's all a factor of demand. If people are spending money, then CPI would continue to go up, but they have not been spending money. Credit has pretty much stopped. They've maxed their credit cards out. There's no more credit available. Okay. So they're not spending money. Walmart has reported that they've done the best since the great financial crisis, because your middle income to higher income people are now shopping at Walmart. You've got Home Depot that has said, we expect bad things to happen in our future projections, because we're not seeing the consumers come back. We're still seeing our professionals are buying from us, but our discretionary spending from our consumers, they're not spending as much. Yet Walmart is saying their best department is home and garden. So they're leaving Home Depot and they're going to Walmart. They're leaving Lowe's and they're going to Walmart because of the bargain prices. Okay. Isn't it common for them to always revise? Yes, it's always common, John. And the reason is because they have to do the data. So they're going to give you a projection. They take a small sampling, about 10%, and they'll give you that initial data. And then it takes 5 months. So always in August, March, the numbers reported. In August, they'll revise it. Just like every month, they revise the monthly job numbers, and the numbers always go down. Okay. So good question. And yes, that is true. All right, last one. Average weekly hours to continued claims. We can see continued claims is starting to go up. And if we look at the average hours worked, they have been decreasing. Now, it's not a lot. So it was at 35 hours at the peak, and now it's down to 34.2. But when was the last time, excluding COVID, when was the last time it was at 34.2? We got to go all the way back to the recovery from the Great Recession. And prior to that was when we were in the Great Financial Crisis. So you remember I said, I believe, and economists believe, we are already in a recession. Okay. Not a technical recession, but when you look at employment and when you look at earnings and you look at wages and everything else, you can see that we are more than likely already in a recession. Now, the last thing I want to leave you with is this. I heard this recently. And what I heard was that the banks are insolvent, except for your big five. The rest of the banks are pretty much insolvent. They don't have money. The reasoning behind that, they said, was, and it makes a lot of sense, that when the banks got their money from the Fed at 0, they turn around and they lend it at a little over 2 to a little over 3. I got mine at 4.25 in 2015 for my house. They were doing 30-year fixed mortgages at next to nothing because they had that delta, that spread. Well, when they bought those T-bills from the Fed, that's a 10-year treasury, those T-bills are now due. And now they're due at 5.5, but they bought it at next to nothing, and they've only been receiving, say, 2.75 to 4.25. It's all they've been receiving. So the banks are now upside down in their deposits because of this. Now they're saying the lenders are probably going to give them, or the Fed's probably going to give them, or the central banks are probably going to give them a year on this. But like everything else, because the government's got to pay their bills and their interest, they've got to get that money back off that T-bill that the bank got when all this free money went into the marketplace. You may be asking yourself, when the Fed prints money, where does it go? Goes to the big banks, the big five. Okay, that is the Fed. The big five is the Fed. That's the central banks. It goes to the big five. The big five then turns around and gives it right back to the Fed in the form of T-bills. And then they take those T-bills and they use that to loan it out to the marketplace. Okay, that's how the financial system works. Well, now that money's due back. And unfortunately, they're negative. And so the indicator here, and we saw this last year with Silicon Valley Bank and Signature Bank, we saw some cracks and some failures, but FDIC stepped in and saved, I think, one of them. and one of the big banks saved the other one. Now both banks are gone. They're not here anymore. They were absorbed or went away, but the FDIC covered the deposits that weren't covered from the purchases. Well, I heard that there was about 9 trillion in deposits in the United States that is less than $250,000, and that's what the FDIC will insure you up to $250,000. So in the lending, in the institutions and all the banks around the United States, there is about 9 trillion. That's what I heard. And I heard that there was only 800 billion in reserves to pay for any failures from the FDIC. That's about an $8 trillion shortage. So if a bank fails, how many banks is it going to take before the FDIC runs out of money? Pretty stinking quickly. Now, there's a tool that's better than ChatGPT. It is a tool that is competing with Google as the next search engine. It's called Perplexity, perplexity.ai. Check it out if you haven't used it yet. So I went in and I asked Perplexity, what's the total amount in deposits currently insured by the FDIC? Well, it didn't know. So I revised my question. I said, what is the estimated total amount of deposits? Because the actual is not public information, but it gave me a bunch of resources on how it computes data. So I said, okay, well, based on the data you provided me, what's the estimated total amount of deposits? Now, remember, I had heard 9 trillion. Perplexity came back and said it's 10.57 trillion. So I said, okay, well, that's interesting. So there's a correlation there. One or the other. Again, it's estimated. It's not accurate. So then I said, all right, Perplexity, based on that, what's the total amount the FDIC currently has in reserves to pay out claims if needed? And this is public information. 125.3 billion as of March 31st, 2024. If that doesn't scare the shit out of you, nothing will. The smaller the bank, the more that should trouble you. If you have your money with Bank of America, you're probably okay. If you have your money with Wells Fargo, you're probably okay. If you're like me and you have your money with Service First Bank, which only has about 7 branches and is based out of Birmingham, Alabama, I'm probably not going to be okay. That's all right. I don't have much in the bank, so I'm not worried about it anyway. But I'm probably not going to be okay. So if nothing else scared you through this whole thing and made you think, all right, can I live off that market cycle chart and say, buy when it gets to the bottom without taking any of this other stuff into consideration, then I'm never going to change your mind. I'm never going to make you think outside the box. I'm never going to make you think economically. Good luck with you. Okay, you're probably not going to fare very well if you just start buying without knowing the rest of this information. I didn't put a whole lot of data here for what residential is doing because it's a lot of skewed information. It's really hard data to find. What I'm hearing, and it's just hearsay, and I don't have an opinion on this one way or the other, although I did say it in a post the other day and that triggered a few people. They're expecting real estate, residential real estate, doesn't matter whether it's multifamily or single family, they're expecting it to drop about 50% in value in this coming recession. That's the expectation. Office obviously will do worse. Industrial will obviously do better. Okay. But for residential, they're expecting somewhere around 50% correction coming in this recession when this recession triggers. Visually, we'll find out next week. Guys, watch next week. Next week's going to really tell a big story on whether we see it early in the fourth quarter or late in the fourth quarter or even early 2025 when the visual recession will finally kick in. And I think you'll see that when it's all said and done and revised, that they'll say we've been in a recession since about March or April, which is what all economists believe right now. Okay. That's it. That's what I had to report. That's what I wanted to bring you guys on and tell you. I think it's extremely important that people know this. I will be posting a recording for this for everybody, not just the ones that registered, because everybody needs to know this information. Take from the data what you get from it. They make your own decisions. Don't follow me. Don't listen to a damn word I said because I don't know what I'm talking about. I am not an economist. All I do is look at the data and see how that data affects my decision making. Okay. Any questions? That just tells me I just put every one of you to sleep.
No, good stuff, David. Thanks, man. Appreciate the input.
Are you sure, George?
Well, hey, like you said, you gotta be ahead of the 8 balls, not behind it, so, or try.
David, can I squeak in a question?
Absolutely, Michael.
What are your thoughts on, you said that, when you were discussing the 50% drop in residential values, you said that the industrial market will do well. What are your, can you expand on why you think the industrial market will do better or sort of hold its own?
Yep, let me show you. All right.
And the main reason I ask, I should probably give you a little background on why I'm doing that. I've got a project that we've been working on, and we're pretty close to getting some private equity funding.
Yep.
And I need a large industrial building.
Gotcha.
And I'm in the greater Cleveland area, and while you were talking, I jumped on and I was looking at other Dr. Muller's other predictions in the industrial market.
Yep.
And Cleveland, significant parts of Ohio seem to be in a growth phase.
Where's industrial?
Or I'm sorry, expansion. Yeah, you're probably going to bring up what I was looking at.
It's not that it's an expansion. It's at what's called equilibrium.
Okay. Yeah, approaching. Yeah, pretty close.
So it's at equilibrium. So that means demand and supply are equal. That's what equilibrium means. Means rents falling or rising. It means occupancy is not falling or rising. That's equilibrium. And he can back, and he'll back markets back into expansion, or he'll move them forward into oversupply. But yeah, if you look up here, there is Cincinnati, there's Cleveland. Is Columbus in here too? Nope, Columbus is in oversupply over here. So your three big markets in Ohio seem to be faring okay right now. The reason I say industrial will do better than the other ones is this reason right here. This is e-commerce retail sales as a percent of total sales, total retail sales. Okay. In COVID, it peaked, and it peaked at 16.4. After COVID, it dropped, and it continued to drop until Q2 of 2022, which is about the time interest rates started to go up. And then it started to climb again. And now it is at 16.0, which is only 0.4 off its peak. So online sales are continuing to grow because Walmart and Dollar General aren't your only bargain shopper places now. What is Amazon considered?
Oh, I've got friends that jump. I mean, they don't go anywhere. They just they've got Amazon Prime memberships, and anything they need, it's boom, 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 right to Amazon.
Yeah. But Amazon,
I jokingly yell at him. I'm like, stop putting more money in Bezos's pocket, will you?
Amazon is considered the online bargain shopper place. So people are buying online because it's cheaper, and with free shipping and everything else, it's cheaper than going to the store to get it.
Yeah.
Especially if you have to travel because of gas cost.
Yes. The e-commerce, the chart that you have up, is this primarily aimed at warehouse? Because the industrial market has several subcomponents. Is this strictly looking at warehouse space, not manufacturing space?
Correct. This is for warehouse. So main distribution center warehouse.
Yeah, those seem to be popping up like mushrooms all over the country.
The rule, and you guys know what I think about rule of thumbs. The rule of thumb for this in the industrial world is for every $1,000 of online sales, you need 1 square feet of industrial space. And that's how you can determine demand for warehouse space.
Is there a sort of a subcomponent on for manufacturing space?
Actually, there is. I teach it in 102. It's kind of a bullshit demand model because, and I display it like right after I do the demand model for industrial, because it's based on, with manufacturing, so many people in a sector, and in NAIC, we use it by the employment sectors, the NAIC sectors, National American Industrial Classification System, which was introduced in 1990 with NAFTA, the free trade agreement. That's when NAICS came out. And we were using SIC, the standard industrial classification, but SIC is in stone. It doesn't change. The deal with NAICS, now that we have 2 other countries that do it with us, it changes. It's fluctuating. It's more like a business plan. It can change. And the first 5, it's a 6-digit code. The first 5 of the 6 digits are common to all 3 countries. And the 6th digit is indigenous to only the specific country. Well, so many, like if you have a sector for manufacturing, in that sector, there are so many employees, and there's a number of employees, that's a better way to put that. There is a percentage of employees that will be manufacturing using employees, not warehouse, not flex, not research and development, but manufacturing. That percentage of employees is what gets represented in the demand model. And then you put a employee per square foot number to it by the amount of employees in the market space divided by the total number of square foot in the marketplace to determine how much square foot per employee you need. But that's a bullshit metric. It does not hold true.
Yeah, I would argue that because I've got friends who own machine shops, and you can't, you can put, if you're going to use that, depending on the size of the machine, you can put more employees per square foot, depending on the operation that they're doing.
That's correct.
So,
and that calculation does not change for warehouse. And so what I do is we do a calculation for a market that says you need 496 employees per square feet. It made no damn sense. And then I show a 1.8 million square foot distribution center for GE in Ontario, California. And I say, how many employees are in this facility? There's only 215 employees in that entire facility. So the calculation makes no sense. But that is
highly automated.
Yeah, because it's because of automations. That's exactly right. Because of automations.
Highly automated.
Yep, 100%. What's your perspective overall on buying multifamily if we haven't bought anything yet? Wait, run, only certain markets. I'd wait a little while, honestly, because things are going to change, and they're going to change drastically. Now, there is going to be a ton of foreclosures coming in the next 6 months. So you can make some better decisions on the foreclosures because they'll be so cheap. And you'll be able to sustain the change in values, because basically those foreclosures, they're probably going to be valued appropriately anyway, and you might be okay, especially if you could buy it right. So if you can find foreclosure opportunities, those are probably buying opportunities, but I wouldn't be buying anything at retail price today, or even what could considerably be a value add price. Don't go there at all. That's a sucker's game right now. And that is my professional opinion. It's just an opinion, but it's based on my risk. Your risk may be different, but that is what I would do if I were purchasing. I'm not. It's a good question, Michael. Good question, Miriam.
Thank you.
What else you guys have?
Oh, David, one more other quick question that's seemingly unrelated to this. And forgive me if this comes across as ignorant. I'm one of your students, and the multifamily, the analyzer. How do I get to that?
Are you talking about that synthesis analyzer?
Yeah.
It's in labs. So if you go to the Kartra membership, go to labs, go to financial tools, it's in there.
Okay.
David,
Yes, George. Hold on, George. Michael, if you don't have your login information anymore for that, because it's been 2 years since you've been in there, then just email me and I'll resend your login information.
Thank you.
Hold on, George. Nate, is that how you pronounce that? Or is it Natty? Can you share why you aren't purchasing? You mentioned you aren't because the market's stupid. I haven't purchased since 2018. Market just got too stupid after that. I am a fundamental buyer. I am not a pro forma buyer. And that's all that's been purchasing lately are pro forma buyers since about 2018. That put me right out of the market. And I'm not going to try to compete. I got better things to do, more important things to do than to compete with people that are overpaying for properties. Hope that answers your question. But again, that's my risk. That's not everybody else's risk. She asked, or he asked, I can't tell, don't know who it is. Can you share why you aren't purchasing? You mentioned you aren't. That was a private message. Any other questions? What do you think about master lease agreements for multifamily? I love them if you can find one that'll do it. But if it's your first deal you've ever done, you better be doing it with somebody that knows what they're doing, or you will fail quickly. Because you have to operate a property. And if you don't know how to operate a property, you don't need to be doing master lease agreements. Okay. Got to have experience to do that one. That is not a no experience strategy.
could I jump in now?
You may.
Okay, your e-commerce source is right on the money, because yesterday or a couple of days ago, I was reading a something off of CoStar indicating that the increase of TEUs in the ports of Long Beach and LA have increased in 18, almost 21%, that they've never seen. That they're bringing in so much stuff, and they're kind of averaging at a year about 5 million plus containers. Okay, David, if the market continues doing where it's going, where's all that stuff? Pricing is going to come down?
Yep.
Or everything is going to, because it's not going to stop. It looks like they're
Okay.
just really turning the wheels on it.
Here's what's happened. Manufacturing has been in decline over the last full quarter, probably we can go back 5 months now. I think we've had 5 straight months of decline in manufacturing. And it's continuing to go down. It's going down even further. You could see it in the PMI and in the ISMs. You can look it up to see what PMI and ISM is. It just has to do. PMI is the Purchasing Managers Index for manufacturers. And I don't even know what ISM stands for, but they're related to each other. And it has to do with how we gauge manufacturing for demand. And you remember, wages are going down. Unemployment is going up. Well, people have stopped spending. So demand has decreased exponentially. And because demand has increased, manufacturing has because demand has decreased, manufacturing outputs have decreased. But here's the problem. We're not seeing a whole lot of unemployment yet. The reason we haven't seen it is because the manufacturers have bought into this soft landing, and they believe, like everybody else, that when the Fed starts to lower the rates, that people will go back to the market and start spending money. I don't know where they're going to get the money. That makes no sense. Most people aren't even going to know rates were lowered because they're not paying attention. It's not like their credit card company is going to give them extra credit on their credit card, and it might lower their interest on their credit card from 24 to 22. Is that going to spur somebody spending? No, it's not. So what's going to happen is, or what the manufacturers believe is that we're going to have this soft landing or no landing at all, and everything is going to be fine. Demand is going to come back when interest rates come down. And so we're holding on to employees and we're increasing supply. And so we're starting to see that increase in supply, which is helping bring prices down because there isn't demand for that supply. But what's going to happen when the demand does not come back, when the Fed does lower rates, the manufacturers are going to have no choice and they're going to have to lay all those people off they've been holding. And that's when we're going to see that exponential rise in the unemployment rate. And this happens every cycle. That's why you see that exponential rise in unemployment.
And you believe that'll occur middle of 25?
Probably before the end of the year. I don't know for sure. From what I'm hearing from people that know and have been following for years and years and years and years and decades that do this for a living, they believe it's going to start before the end. Actually, it's already, we're seeing the uptick. You could see it in that unemployment rate.
So
we're already seeing that exponential rise start to happen. One of the economists I follow call it a non-linear progression. So we're already seeing it. The question is, how fast will it accelerate? That will depend on when the manufacturers lose faith in the Fed and they just start laying people off.
That's why you're saying that the report on Friday is going to be very critical.
Yes, sir. Very critical. 100%.
Thank you.
What do you think? Okay, that one was already answered. Good question, George. Anything else, guys? See, I told you hour and a half. I was right on the money. For foreclosure properties, do you have a suggestion for the best method of finding them? No, Reonomy doesn't produce foreclosures. You will need to have a resource like TREP or Real Capital Analytics. Moody's is promising to have that data. I just don't think they're there yet. Because then you can monitor 30-day, 60-day, 90-day delinquents through all loan types, whether it's agency, whether it's CLO, whether it's CMBS, it doesn't matter. CoStar only tracks CMBS. Yardi Matrix only tracks CMBS. The other tools, they only track CMBS. And that's not enough. That's only 16% in multifamily. Only 16% of loans are CMBS. The rest are either Fannie, Freddie, or CLO, or local banks. And so TREP and Real Capital Analytics are your two best sources. Or build relationships with lenders in the markets that you want to be investing in and hope that they'll give you that information as they come to market. Keeping in mind, if it is agency protected, so if the loan was backed by Fannie, Freddie, HUD, FHA, any of the government entities, Ginnie Mae, though you don't ever hear about Ginnie Mae anymore, if it is protected by any of those federal agencies, then it must come back to a broker. It's mandatory. It cannot go back quietly. Where you're seeing these CLOs, the bridge debt, you're seeing these entities take properties back right now and sell it to institutions quietly. They can do that because those aren't backed by agency debt. If it's backed by agency debt, it has to go back with a broker. Answer your question, Miriam? Good. Yes, ma'am. Any other questions? I'd like to end it there, if you guys don't mind. We're already 30 minutes into the first college football game. Well, technically not the first. There was games last night and there was a game last weekend in Ireland. But other than that, started the college football season, officially launched 30 minutes ago, and I'm missing it. So I appreciate you guys. If you guys have any questions, for those that aren't members, there's only a few of you here with me. If you want, email me, david@davidmonroeccim.com. We could talk about how to bring you on as members. We have this conversation every Friday at noon Central Time, 1 p.m. Eastern, 10 p.m. Pacific, or 10 a.m. Pacific, not p.m., 10 a.m. Pacific. So if you want to have a conversation about what that looks like, trust me, it is not guru pricing in any way, shape, or form. It's actually really, really, really affordable. So love to have that conversation with you. Other than that, you guys have a great weekend. Go Irish. I don't know if you can see, that's my Irish shirt. I'm an Irish fan, play Texas A&M tonight. So we'll go spank them Aggies. I hope.
Have a good holiday, David.
All right. Thanks, everybody.
Thank you.
Bye,
Thanks.
Michael.